Hello guys, this is Poppyjoe and I want to welcome you back to my YouTube channel. So in today's video, I'll be starting a new series and that is going to be on market structure. So we're going to be going from the basic all the way to the advanced part of market structure. And I'm going to be showing you all of this my own way, right? So you are going to learn a different perspective on how you can look at market structure. You should know that market structure has different meanings to different traders. Some will call it algo trading, algo structure. Some would say it's advanced structure. Some would say it's order flow. It has a lot of meaning to different traders. So what you are going to learn today is a unique way of looking at market structure, especially the advanced part of it. I always tell people, if you think you know market structure and what you know is higher highs and higher lows, you're on a long thing. So most times I've tried to apply market structure the way it has been taught to us, the normal higher high, higher low kind of thing. And it was not clear to me. Like, that's for a fact. The same way you would think you understand it, when you ask people about market structure, everybody believes that they know it. Like, it's not just higher high and higher low. Oh yeah, now, come and show it on the charts. Come and show it on the chart. You will realize that it is more difficult than just boxing higher highs and higher lows. And talking about even the alignment on the time frame side as well, there's a whole lot of things to it. And I also built a framework on how you are able to master, or should I say, how you can trade market structure in a professional way, right? My framework is the one don't worry, let's keep that for later. So if you are new and you're just coming across this video, make sure you drop a like, make sure you subscribe, make sure you share this video, and you're going to be getting more and more of this. There's already enough talk on CLT, MSLR, and all those things. So let's shift the focus a little bit back to market structure, because it actually matters. In all of my trading strategies, market structure plays a vital role in that, and not the basic one. Like I said, we're going to look at the advanced one and how you can also master it in a professional way. A lot of people that have been struggling with, using market structure for confirmations, when price gets to your POI, you are looking for that shift, that change of character. And, many people even misinterpret what change of character is. So we're going to look at all of this, and I'll also tell you the journey of how market structure is, all the way from the beginning, which is the basic, all the way to the advanced way in the PSC style. So without wasting time, what do you think? Let's get into it. So the first thing we're going to talk about is what market structure is actually representing, and that is the trend of the market. So anytime you want to talk about trading, the first thing you must figure out is determining the trend, and that trend can be determined using different methods. So we have methods like trend line, we have methods like technical indicators, we have people that use moving average and some other things to determine the trend, and that is the same job that market structure is going to do as well. So everything is pointing towards the trend of the market. And knowing the trend means, we have heard this popular quote, the trend is your friend. So knowing the trend is very, very vital, right? And we are going to look at how market structure can help us to determine that effectively. And the first thing we are looking at is the basic market structure. Now, everyone has actually learned this in their basic class one way or the other. If you want to determine who is in control or who is dominant in the market, we look at the trend being either bullish or bearish. That means we have either the uptrend or we have the downtrend. So we either have uptrend or we have the downtrend. So those are the two types of trend that are kind of dominant, right? And knowing the direction or the trend helps us to make informed decisions regarding whether to buy or to sell. We know that in uptrend, buyers are dominant. So let's put this here. Those players that are actually dominant in uptrend is for buyers. So we can say uptrend is a buyer's market, right? And downtrend is a seller's market. So this is very, very important that we state clearly now, because the information is going to help you to know what you are doing even when you get to market structure. So knowing who is in control of the trend helps you to know whether to buy or to sell, right? And that's what market structure will do as well. So look at the market over here. Of course, we know the market moves in wave. Market does not move in straight line. It does not just go in a straight single line. It actually moves in a wave-like motion, right? So, and the movement you are looking at here is just a typical move of the market on the chart. So we always have the market creating series of highs and lows, series of highs and lows. So in basic form of market structure, we would say that a bullish market structure can be defined when the market creates series of higher highs and higher lows. So we're going to annotate that accordingly using this method. So this is what we'll do in basic class. This is basic class 101. So, and this is normally what every other person would have done. But don't forget, the major aim of this class is not to come and teach you or introduce basic market structure to you. Rather, it is to clarify the kind of mistakes, or should I say, the false beliefs that we have on market structure before now. These beliefs are things that we have taken to be normal, to be the general way to look at structure. But the reality is far, far different from what we have been told. So those realities are the things that we want to bring to light. So I want you to pay attention. And if you have not subscribed to this channel, make sure you do so now before we continue. Okay? I'm guessing you are doing that already. All right, let's continue. So now we'll go over here. This is higher high and this is higher low. Okay, these are the lows and highs accordingly. We have higher low, higher low. So this particular method of annotation, I always regard it as the basic or beginner's method, or we can just say it's an amateur method of annotation. Because anybody you see currently and is posting a chart, and the person has higher high, higher low like this on the chart, automatically you will believe that this one is a beginner, not DJC, because it seems very, very basic, right? So what are the methods we are going to be using, or I'm recommending to use in annotating your chart in a much more better way? So we're going to look at those few methods that you can implement on your own. So this is uptrend, and in the downtrend, we know the market is made up of the lower lows and lower highs. Okay, so we have lower low and we have lower highs. So this is what makes, or this is how we define the uptrend or downtrend. So all these higher highs and higher lows is like just saying that what is the characteristics of a man. So what are the things you would see in a man, in a male person? Now say this particular person is a man, or this one is a lady, right? So those major things are what you use to define a man, and the same thing for uptrend. In uptrend, once you see the market creating series of higher highs and higher lows, then that is uptrend, which we call bullish market structure. And this also for downtrend, lower lows and lower highs is what depicts a downtrend, which is a seller's market. Don't forget, this is seller's market and this is buyer's market. Okay, so and the next thing to note is the impulse and correction moves. Okay, impulse moves are the ones that we take to be the ones that create the new high. So anytime you talk about impulse, those moves from this low here to the high, that move that breaks the previous high, those moves that keep on creating new highs. For example, this particular one is the one that went ahead to create a new high. So that move that successfully creates a new high is known as the impulse. All right, is known as impulse. Normally, we say in trading, we want to always catch impulse because that is the one that aligns with the trend. Remember, we say uptrend is buyer's market. So if you take a trade, which is a buy trade, along this impulse, you have a high chance of making more money than someone catching retracement, right? Or even retracement itself is known to be very risky. So this is just basic market structure 101. And we are going to get to the advanced part as well. So this is impulse move, and these ones are called the retracement moves, or you call them correction. Okay, these are the retracement moves. These are the moves that sellers will take over for a short period of time before buyers will come back and take over. So these are retracement move. And retracement is normal. Okay, the market moves with both impulse and retracement. Retracement is normal. In fact, just know that most of the time the market is always in a retracement phase. How many times do you see the impulse always happening? If you look at the market let's say the market creates a single impulse like this, you would see the market will take or spend a very longer time during the retracement before another impulse. So in most times you would see the market in retracement phases than you would see it in impulsive state. So that's why impulse and retracement moves are very, very important for us to know. So this is impulse and correction, and Yeah, these are the basic market structures 101. So I was talking about a better way to annotate your chart, not to look or sound, not to make your chart look very ordinary. So we're going to delete all these methods, and I'll recommend a simple approach that you can use to annotate. So the first one is using arrow 2 at your previous high. Okay, this is the previous high, and we place BOS at that high. Now, this is where we are going to quickly look at two types of BOS I have as well. BOS are things that, we call them break of structure. Now, the purpose of the class, like I said, is to give you advanced knowledge on market structure. So take this as part of the things that will illuminate you on what you don't know on market structure. So BOS is in two types. We have the continuation and the reversal. Okay, so we have the continuation BOS, and then we have the reversal BOS. Okay, so the continuation BOS are the ones you see um at the break of the highs or lows. For example, when you see me place a BOS here, I'm actually referring to the continuation BOS, because take a look at it. What makes this uptrend still, like, what makes this particular thing a bullish market structure? Would say as long as the market keeps on breaking the previous highs. So this is a previous high right now, and this is a retracement. Now, for this particular trend to remain being uptrend, what must happen? The market must go and give us a new high. So once a new high is being created and price crosses above the previous one, then we say we have a new high, which means the bullish trend still continues. Hence, the reason why we call this ones the continuation BOS. Okay, so these are continuation BOS. They guarantee the continuity of the trend. Okay, and then we have the reversal BOS. Market will not forever be in an uptrend state, right? So there are times the market changes direction, and those times are the ones we call the reversal. So when the market breaks the recent low right here, what we say is we have a break of structure. Now, but this break of structure here is a reversal break of structure, because it's an indication that the market will sell and not buy. So it's very important to take note of that. This is not a buy indication, rather it is a sell indication. So if you have been buying before, then all you need to start doing now is to start selling, right? So these are this is what I do to annotate my higher high, you can see the continuation highs. So what do I do at the low? You are going to make use of highlighter, right? So in case you don't know where to get it, let me show you quickly. So you're going to get the highlighter to right at this point. So look at this, where you have your brush and then your highlighter. So a single touch is enough. You can see the color I chose, black, and then a very light. It's not that deep. You can see something like this, but I made it very light, something like this. And you are going to place that at your higher lows. So this is how I identify my higher lows, right? This is what I use to identify the higher lows. Okay. So let's move on to the next important thing, right? So the same thing is will be done for the bullish or the bearish trend to bullish as well. In bearish trend, we are going to annotate like this. The market remains bearish like this. Now pay attention to the positions of my text. You can see the positions of my text, right? So, and if the market were to change and become uptrend, it is when it breaks the recent lower high. That is when we say we have a break of structure, which is this to the upside. And we're going to annotate this way for our lower highs. So now that we have sorted this particular one out, we are now going to get into understanding of the advanced market structure. So in advanced market structure, there's nothing special that will be happening than just a rewiring of our mindset on what we actually previously believed to be true, right? So over here in advanced market structure, the first thing we are going to be doing is we are going to be changing some facts of what we know, and we are going to be replacing them with something else. Now, over here, you can see what I have here. I said daily range or structural range? It's actually meant to be a topic. This guy here is meant to be a topic. And what is daily range or structural range? It is the new impulse. Okay, so when we talk about advanced trading, we are trading daily ranges. You would hear us talk about the daily range and this. Now, daily range is actually more like well, I'll explain it to in a simple way that you can understand. So we're going to look at daily range like this. When you have a trend, higher high, higher low, higher high, higher low, higher high. So we're going to take it that your daily range is equal to your impulse, your valid impulse. So I'll be giving you three different annotation, and then we're going to do it like this. We're going to use a method like this. So we're going to have A, B, and X. So we're going to have A, B, and X. Okay, let me just do it once in here. So A is going to be used to represent the starts of range. B is used to represent end of range. And X is used to represent invalid. So this is important for us to know. So in daily range, we are going to say that our daily range is the same as our impulse move. The only difference is that it is valid than the other. So this is the start of an impulse, obviously. So we are going to say this is our, our daily range low. And this is the end of our daily range. Clearly this is a simple thing. We are just saying daily range is the same thing as impulse move. However, there's a difference between daily range and impulse. The normal impulse we have actually understood or we believed in basic market structure. Now, one of the things that you are learning this particular advanced stuff for is because more often times than none, you would always see the market create structures like this. For those that know, then price will break structure. You would think it's going to start selling, and then we just continue buying. So there are many times you've been trapped by this fake breakout, and you are still wondering, there's a break of structure here, but why is it not selling? You want to know the reason why it is not selling, and I am here to provide you answers for those particular things. So right here, this is the impulse low and your daily range high. Clear as daylight. Daily range low, daily range high as your point A and your point B. However, the point X, where does it come in? And that's going to take us to the advanced market structure models, because market structure in real time does not behave like this. In real time, you would see the market structure not really give you higher highs and higher lows the way you have learned them in the basic structures form. They will not really do like that. Market structure is very, very technical. It's one of the most difficult technical part of trading, right? It is one of the most difficult part of trading because it comes in different forms. In fact, there are a lot of things that you're going to learn on market structure, which I believe without knowing these things, I feel like you are leaving a lot of money on the table or you are hurting yourself a lot. Because so the purpose of learning this is very vital, because you are going to definitely need one or two or three or even all of this in all of this information in interpreting the market more accurately. Okay, so look at this. We said now your daily range is equal to your impulse move plus complete pullback. Now, this was never a thing. It was never part of the requirement that we used in doing market structure before. It was never part of it. All we knew before is that as long as the market breaks the previous high, that's an impulse move. As long as it's breaking the previous low, that's impulse move. So that is what we know about structure. But now we are saying that the advanced, or now I think I can use the word valid daily range. Now let me add valid to it. Valid daily range is equal to impulse move plus complete pullback, which clearly means anytime you have an impulse start, this is the start of an impulse. There must be a complete pullback for you to say that your range is a valid one. Now, what do you know as pullback? Now, pullback is representing or replacing retracement. That simple thing you know about retracement has been replaced by pullback. The English is just the same anyways. So anytime the market makes a pullback, look at this other guy here. There was a retracement. It's like after the break of structure, make sure you don't forget the BOS. Very important. So after the BOS here, what happened? Market clearly made a complete pullback. It made a retracement, went back to the unmitigated zone and flew, and the price moved all the way up. Look at this other one. Let's assume this is under unmitigated zone here, right? And the market makes a pullback and it does not get to that pullback. That is where problem starts. But that problem most of the times is masked in such a way that we don't pay attention to it, or we don't even know that there's a problem there. Because think about it, when you see the market just make a pullback, something tiny like this, and then it just continues buying. Now, the basic thing we've learned about structure tells us that every move that breaks the previous high is an impulse. So automatically, you and I would have assumed that this high is higher high, and would have assumed this low to be higher low. And that is where the wrong thing always comes. Because once you make it like this, you have already missed out a lot of things. First, it's already set for failure. That's just the fact. I don't want to use the word failure earlier, but it's already set for failure, because once you already interpret your structure like this, then there's a lot of problem that you are going to face on that. So how do we solve this? How do we recognize this particular thing happening? Like, how do you, or no, because I'm even saying it now, I'm not even showing you the reason why. So I'm going to show that quickly, and we're going to round up for this episode. We have more episodes coming up on this particular topic. So just don't worry, you're going to get more and more, like I said. And yeah, that's it. So hold on. The first thing you're going to do is you are going to bring out your Fibonacci retracement tool. So this is the part the Fib retracement tool will be playing a major role. And what is the role is going to play here? First thing is a pullback must be complete. That's the first fact I want us to establish. Anytime you have a retracement, your retracement should immediately, once market breaks the previous high, that we have a BOS, we need to see a complete pullback following it. So the complete pullback means price retracing back. This is what we mean by complete pullback. Price retracing back to the unmitigated zones now, and mitigate and then continue. That means everything is fine, everything is good. However, if the market does not do that, and you just come to see that the market made a pullback, let's do this. You apply your fib from the low of your range to the high. Now, if you're using fib for the first time, it's going to look like this. So quickly set it like this. Go to the settings. Okay, make sure you follow the settings I'm doing now. The trend line, turn off the trend line, very important. Then you turn off every other levels here except 0.1 and 0.5. 0.1 and 0.5. So, and just copy my settings. For one, I'm putting blue, and for this, I'm putting red. So, and the other thing is my label should be at the center, okay? At the center, or I can just turn up, I can just turn up the, I can just turn this off, actually. I can just turn it off. So what I've been able to do now is I've been able to use Fibonacci now to get equilibrium and discount. So below this level, or let's say this middle point you are seeing here, is a 50%, and that's my equilibrium. Okay, equilibrium of the range, that's the 50% of the range. So below equilibrium is discount zone. Anything below that point, below this equilibrium is discount zone, and that is where you're expected to buy normally. And anything above it is known as premium zone, where you should actually be selling from. That's for those that want to do counter trend. Anything above 50% is your chance to do your counter trend. All right. So once price crosses into discount, you don't really have to do any counter anymore. Now, look at this. It's a very simple and straightforward thing. That's the same thing that has happened here in the past. Look at this. Low to the high. Price made a pullback. Where to? It came into discount zone, right? And mitigated and, traded all the way back up. Now, in any case, I'm going to really show you three models today, three advanced models that I can use for everyday use. And I want to pay attention. Now, look at the models. First thing here is the BOS, always constant in all of this, the BOS. And once the market makes a pullback like this, and that pullback clearly, so the pullback clearly did not touch the equilibrium, did not even get there before the market went to create a new high. Now, I'm not saying before the market made another high, which is not the high, the new high must take out the previous one, giving you that impression as though the market has continued the bullish trend. So you must see a new high like this after this shallow pullback. So we call this particular thing a shallow pullback. So let's label this accordingly, shallow pullback. Very important. And the shallow pullback is not a bad thing. It's just part of the things that is like market is building up something for us. So this low is known as a shallow pullback. And you are going to label that low as your inducement. So that low is the one we commonly use as inducement. And also that low is your point X. Okay, that particular low is your point X. And point X are very, very good in trading. Very, very good in trading because most times, if you just trade this other one after the break of structure, there's no liquidity, there's nothing, price just immediately come back to POI. Yes, it might, it's not common to be honest, but that's the normal expectation everybody always expects. But in most cases, you would see the market have inducement like this. And that's the purpose of saying you should label that as point X. Now, your point X is not, is like a warning. It's like a warning because you are not expected to buy anything like, if price starts making a retracement above now and it starts coming down like this. The first thing is you are not even going to assume that this is your point B because it is not. Remember the law of your daily range. A valid daily range is going to be gotten with what? Impulse move plus complete pullback. Now, this is the point of interest and it has not been mitigated. Price ought to come down there. It did not do that. So that means your impulse here has not ended. And I use the word, I will say the phrase impulse continua, which means impulse continues. Because until the market comes back to its senses and comes back deep into this level, the impulse move is still present and it is still valid. So right here, this is the inducement move here. And now, whenever price now decides, remember your point B is the end of the impulse. So anytime you are labeling, you don't even call this your point B yet. You will not call this point B until it has completed the pullback. That means until the unmitigated zones at discount has been mitigated. So right here, if the market comes down here and now starts going up. Now, what do you notice about this? First thing is a beginner that would have assumed this is higher high, this one is higher low, would have interpreted this break as BOS, meaning it will be expecting a break of structure and a reversal. But based on the addition of this current knowledge you are acquiring now, you are able to know that this particular thing is not break of structure. It is normal. In fact, the range itself for the bullish is still valid. And that's why you see the market will go ahead and create a new high because the range is still valid. It's still a bullish range. So when we get to reversal, I will even show you my simple trick in getting accurate reversals, so that you are able to tell if truly there's a reversal about to happen or not. I use TBOS and the double BOS for that, but we are going to get to that maybe some other episode, right? But now this is clear, and I think you should understand this very well. So, and it has a formula. Now, it has a formula. The formulas are done to make it easy to remember. So, this is BOS plus inducements plus POI. Now, clearly, what I've been able to explain here makes a lot of sense, right? It makes a lot of sense because look at it. After the first pullback, it's clearly not coming down here, right? So that means the market needs to find its way back to complete the pullback. Remember, a valid range must have what? An impulse plus complete pullback. So if this impulse here continues doing up, down, up, down, up, down without coming back, that means the impulse continues. So that's why you can see some cases that impulse can be as long as anything. But a beginner trader might not be able to realize that because he believes any single high and low, any single break of a high is assuming that that is a break of structure. Now that's an impulse move and all that, and that's not true. So what you are seeing here is what we call a valid daily range. You can see that's A, X, and B, valid daily range. So I want you to take note of this, very important. So this is the first model I want to show you. The second one I will show you is very similar to this one, right? And this is how that one looks like. Higher high, higher low, higher high. So I want to spot the similarity between these guys here. So it's still almost the same thing, right? Almost the same thing. And one of the reasons why I love this particular model is because it specifies where you are going to buy from. So in this other case, we had a shallow pullback after the break of structure. Look at it. After BOS, we had shallow pullback. Same thing happened here. After the BOS, we had a shallow pullback. You can see the tiny pullback is a shallow one. But what do you notice? The shallow pullback, which is inducement, has a gap. There's a gap between that point and the previous high here. There's a gap. So that gap that exists now has made it possible for me because now I'm going to choose this neckline as my POI. So this neckline is going to be my POI. And we call that neckline the secondary POI. Secondary POI. So this neckline, which is a secondary POI, will be chosen as the point of interest to buy. This is one of the common models you would see me trade. Why? Because it's very, very profitable. It is very, 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 very profitable. I think I saw something like that on gold today, right? But let me not relate it like that. Let's be done with the theory part first. Because I saw something like that. Today is Friday, 31st of July, and there's something like that on the lower time frame on gold today. And we're going to see it maybe in some other time. And this is very important. And how does the model even form? See, the formula is still BOS inducement box plus secondary POR. Now, spot the difference. In the first one, the inducement came within the region of the BOS. Look at it. Let me delete this. Let's delete the Fibonacci too. So the first one here, this is the point X. Now, the point X here is above the previous high here. But here, the point X is within that region. So that's why this area is secondary POI. And anything inside is known as primary POI. So if price has already used secondary POI here to go high, and that low, in that point is obviously an invalid low now, market will go deep into internal POI, which is what you see here, going down to the primary POI before going high. But in this other case, if price has not touched the secondary POI at all, when it's making its final retracement, it's going to use the secondary POI to go. That means even if you have the most valid order block here, it will not travel that far because of this gap here. So it's very important to look at the similarity, but you know the way to trade them differently. They are similar, but they can be traded, they should be traded differently. So here, when I see this particular thing here, once I spot something like this as a setup, I already know that my buy is below the inducement and it's deep, right? But if I see it like this, I know my buy is also what below the inducement, but is this POI? Can you see how straight that is? So it's very straightforward and it's very direct to the point. And that's on this. I think that's the second model I'm giving you today. I'll stop on this one for the advanced. I'll stop on this one for today, right? And I actually plan to give you 3 advanced trading models for everyday trading, but I'm going to stop at that too. So in other series, now there's going to be a bootcamp. I've made an announcement in the community, and I know that many other people are already gearing up to join that bootcamp. The bootcamp is a once in a year event. So I'm going to be teaching every single strategy I know in that bootcamp. You see, market structure plays a vital role in all strategies. Either you are trading CLT, MSNL, no matter what, you are still going to make use of market structure. And obviously, you don't want to use the basic knowledge that you have on market structure. So it's going to be very, very important that you learn everything about the advanced part of market structure. And I'm going to be doing all of that in this bootcamp that we're going to be having for the year 2026. Okay, so the registration starts August 1st, which is tomorrow, and we are going to get the registration from the 1st of August all the way to the end of the month of August. And the bootcamp starts the first day in September. So make sure you check the link in the description for the payment link, and make sure you take a part of the bootcamp. Because if you have ever watched my video on CLT or maybe MSNR and even this market structure, this and many more of these, including my trades and analysis, will be given for free in the bootcamp. Okay, so make sure you take advantage of this and you are in the bootcamp. All right. So yeah, other things that we're going to do in other episode, maybe after the bootcamp, is I will be talking about major structure, the substructure, minor, external, and so there are several things we are going to look at on structure, and this is especially external and internal range, crazy, especially external, very, very crazy. It's something that you would even see every day in trading. This external range structure is something that I see. Like I've been a victim of, interpreting structure wrongly because of external range structures, because of that nonsense. So it's something that you must know. It's very, very important that you know it, right? So we are going to review all of this in the bootcamp in the next coming weeks. All right, guys, thanks for watching, and I'll see you guys on the next one. We are going to be releasing more videos on this series, and just expect and anticipate. Make sure you turn on notification bell, and make sure you are subscribed to this channel, and make sure you also share this to your friends, family, and your loved ones. Let them understand the true meaning of structure and how it can make money for you. Okay, see you guys on the profitable side.